Year-End Tax Strategies, Episode 51. Are you ready to make your law firm a profit-generating machine that will free up your time and skyrocket your impact? With more than 2 decades of business growth experience and having proven that you can be successful while prioritizing your family and your impact, introducing the Profit with Law podcast. I am your host, the creator of the Firm Differentiator 10X Effect, Moshe Amsel. Well, hello and welcome to another episode of Profit with Law. I am your host, Moshe Amsel, and before I dive into this episode, I just want to bring to your attention that we are going to be hosting a completely online virtual summit, the Law Firm Growth Conference, the Law Firm Growth Summit. You can find it at lawfirmgrowthsummit.com, lawfirmgrowthsummit.com, and we're going to have 30 speakers talking to you all about growing and streamlining and running your practice profitably. 5 days, 5 tracks: marketing, sales, leadership and team development, technology and processes, and financials. And this is so super exciting. We have a lot of work going into putting this together, and I am really excited to bring this to you. So go over to lawfirmgrowthsummit.com and make sure to get registered. It is absolutely free to attend, and it's entirely virtual, so no need to get on a plane or travel anywhere. You can have all of this right in your office or your living room, wherever you prefer. So without further ado, I want to jump into the topic for today, which is some year-end tax planning. Now, I want to first explain why this is so important. As lawyers, as attorneys, we are in and I say we, I'm referring to all of you. I'm in the same bracket as an accountant. I'm in the same category. So it's, in this case, it is we. We are in a special category of citizens according to the new tax law that was passed back in 2017. And that is that typically a business owner gets a QBI deduction, a qualified business income deduction of 20% of the income of the business gets taken off before the tax calculation. Well, for people like attorneys and accountants, specifically listed in the tax code, it says that if we earn over a certain amount of money, we are excluded from getting that 20% deduction. You lose it completely. And that can significantly increase your tax bill. Besides for that, even without the QBI, if you're in the 22% tax bracket or the 24% tax bracket, and then you live in a state that taxes you on top of that, maybe another 6, 7, 8%, before you turn around, you're paying taxes on about 30 or more percent of your income is going to taxes. And then you also have self-employment taxes if you're a sole proprietor, single member LLC. If you're filing as a C or an S corp, then you're getting paid on payroll, and essentially half of that 15.3% is coming out of your paycheck, and the other half is coming from the company. But either way, you're paying another 15.3% in taxes on top of the income tax. So for any money that you're taking home, you're paying anywhere from 30 to 50% of it in taxes. So if we can reduce your tax bill or your tax liability or the amount of income that is subject to tax, we're going to be saving you we're going to be saving you 50 cents on every dollar. So what that means is that as we approach the year end and as we start to look at how did the business do over the course of the last year, you can start to think about making certain decisions to decrease your tax liability. And right now, in the middle of November, is the best time to be doing this, because some of the things that you might want to do cannot be done as you get closer to the new year, and certainly cannot be done once the year closes. So this is the time to start thinking about them. And I wanted to talk about some of the things to think about in this episode without getting too far into the weeds of the details of each of them. So the first thing I'm going to tell you is that there are some things that you should be doing no matter what, and they shouldn't just be a question of whether you're doing them come mid-November. So, for example, one of them is maintaining an office in your home for your business. Most likely, you already are doing work at home. It's just a matter of making sure that this is within the compliance or confines of the tax code. So the tax code requires that if you have an office in the home for the business, that it be used exclusively for the business. So you can't have a guest room that doubles as your office. It needs to be completely dedicated as the office. Now, it also needs to be something that's required for the business. So typically, you might use it for back office tasks that are not being done in the office. Like maybe you're doing your bookkeeping in the office at home or things like that. So there's definitely easy and creative ways to make sure that you're passing that requirement. Now, the power of the office and home is that it takes a percentage of your out-of-pocket expenses you're already paying for the cost of having your home, and it makes them business expenses where otherwise there was no way to expense them or deduct them from your income. So let's say that over the course of a year, you have out-of-pocket expenses for your home of $30,000 or $40,000 between your mortgage payment, your real estate taxes, your utility bill, and maybe some repairs and maintenance on the home. Now, if you have an office that takes 10% of that space, 10% of your home, then suddenly you're able to take 10% of that $30,000 or $40,000 of out-of-pocket expenses and expense that towards the business. On top of that, you're allowed to take depreciation on your home office that you're not normally allowed to take on your home. So that's an additional expense that is not even an out-of-pocket expense necessarily. Now, obviously, your mortgage payment might be going towards the principal of the home. So essentially, you might be already paying that, each month. But the depreciation is another hidden expense that you're able to take and depreciate your home. And the nice thing is that when you sell your home, right now the tax code allows for an exemption of $250,000 or $500,000, depending on whether you're single or married, when you sell the home as far as capital gains goes. So as you depreciate the home, you're lowering the cost basis of the home. So you're increasing how much you would make in capital gains when you sell it. Well, as long as the new cost basis it doesn't bring you below that $250,000 or $500,000 threshold in gains, then essentially you'll never have to pay taxes on that depreciation that you're deducting as an expense. So some really cool stuff can be done with the home office exemption or deduction, and you can really get creative with it as far as if you have space in your home that you can dedicate for the office. It could be more than 10%. Personally, I run my business out of the home, and my goal as my business grows is to expand my home or move into a larger home to maintain the benefits of the home office deduction rather than paying somebody else rent or needing to purchase another piece of real estate for my business. So that's one thing to think about is some of the things that we should be doing anyway, and that's just an example of one of them. But there are a couple of things as we approach year end that can really move the needle for us as far as taxes go. And one of them is to look at the health benefits that are provided to our employees and to ourselves in the firm. And what's interesting is that there are certain health arrangements that the tax code allows, and those are changing in 2020 again. So what is available to you this year is actually going to change again next year. But there's HSAs and HRAs and all of those things. And basically, what I want you to do is look at your situation from the lens of understanding that you have the ability with these plans to provide a benefit to your employees that would help retain them, help make them happy, help to keep them motivated in their jobs and to stay with you for the long term. And you'll be getting that with your out-of-pocket expenses being only half of what you're actually seeing on paper because of those tax savings. So now is the right time to start looking at that if you haven't been doing it all year, if you don't have already something in place, to see if you can implement a plan. If it's too late for this year, at least going into 2020. But if you can implement it this year and perhaps implement some catch-up provisions in it, then that can essentially be something that can lower your income for the year and allow you to take a tax benefit there. Now, medical plans is harder because you can't really, there's not a lot of backdating that can be done. Can't retroactively give people insurance. You can't retroactively give people reimbursements. So very few of the possible arrangements can actually help you reduce your tax liability for the current year. But we definitely want to start looking at those now so that we can implement them come at the January 1st of 2020. Now, the next big one is retirement accounts. Now, the basic explanation here is that there are tax-deferred accounts like what's popular in the workplace, the 401k. So you could have a solo 401k if you're by yourself. You could have a small plan, a 401k plan that includes your employees. And the nice thing about a 401k is that the owner can put away a lot more than the employees can. So the company can pay a certain amount of your earnings into your 401k. And I don't have the numbers in front of me, but I think that this year you can put up to $56,000 into the 401k pre-tax, where it now is sheltered from income tax, and at least some of that is considered a business expense, and it's going to decrease the income of the business. But with a 401k, you also need to offer that to your employees. Now, there is something called classes of employees, and the different plans allow you to separate your employees into different classes. You can also restrict it to employees who are with the company for a certain amount of time. So, for example, you can have it only kick in for employees who are there for 2 years or more. And then this way, if you often have rotation of employees quickly, you're at least limiting it to the employees who have demonstrated that they're here to stay. So you're not expending any money on and effort on people who are just there for a few months and then turn around and leave. But a 401k is just one example. There's a SEP IRA. There's also something called a defined pension plan or a defined benefit plan. And a defined benefit plan is one where you have to fund the plan based on the calculations of the length of service of somebody in the company, their age, and basically from the way that it sounds, it's a defined benefit. In other words, you determine what the benefit is that somebody would get at the end, and then it's an actuarial calculation to see how much you have to fund the plan today. And the nice thing is that can potentially allow you to contribute a significantly larger amount of money into the plan, which would shield that money from taxes. So a defined benefit plan is what you would look at if you had a really good year, if you're doing really well, and you want to try to limit your tax liability in the current year. Now, once you implement one of these plans, it's kind of there to stay. So you need to make sure that you have sustainability as well. You don't want to implement it just for a year that you got lucky and broke a big case, but the norm is not to have a year like that. You want to be careful about that. Now, obviously, you want to get the advice of a professional with this, and even many accountants are not well versed in these. Like you might be better off going to a company that actually brokers these plans or can really understands what your options are. The thicker into the weeds you go with the defined benefit plans, the more gray, the less information there is out there, and the harder it is to get knowledgeable information. So just be careful that you did your due diligence, that you have somebody in your corner that you trust that is guiding you in this process. Some other things that you can think about doing at year end to just and this doesn't remove the tax liability, but it will shift it from year to year. So instead of needing to pay the tax this year, you can push the tax payment to next year, and that is to accelerate expenses into the current year. So if your firm is running cash basis accounting method, which is what most small businesses are running on, so you most likely are running a cash basis accounting method for your firm. So if you are on the cash basis, then expenses are incurred when you have the cash come out for those expenses. So you can prepay your rent. You can prepay monthly dues on various leases and services that you have. You can certainly prepay your January bills, all your January bills, but there are even often there are things that you are paying monthly for. So for example, your practice management software, you might be paying $40, $50, $70, $100 a seat for your users. And if you have 5 users, you're paying $500 a month or $250, somewhere between $250, $500 a month. You can switch with many of them to an annual plan, and usually that'll save you a couple of months of expense. So if you switch to the annual plan in December and you pay the annual fee, you've now not only have you saved a couple of months of payments because their annual plan has those savings built in and is cheaper, but in addition, you've now accelerated that expense into the current year, and you've eliminated the taxes on that for this year. Now, it'll increase your revenue next year when you don't have the expense. However, because you switch to the annual plan, it'll be billed again the next December. So you will have essentially just kicked the can down the road for a year in when the taxes become due for that income. But it's things like that that can allow you to decrease your current tax liability. And that's really what we're trying to do is sometimes we're able to eliminate the tax altogether, but sometimes it's just a matter of the timing. And we'd rather have the cash in our pocket to spend on marketing, to spend on the growth of the firm, than to pay the taxes. Even if you'll ultimately end up paying it, you get use of that cash for a whole nother year, which can be really, really valuable. There is another tax strategy, and this is not specifically a business tax strategy, but this is to help lawyers and accountants and professionals that are going to be at risk of losing the QBI. You see, the QBI loss is based on the total household income. It's based on your adjusted gross income. So, if your spouse is working as well, there's a good chance that you're over that threshold. You need to look at ways to reduce your income. So one of the ways to reduce the income is with a conservation easement. And without getting into too much detail of how this works, I'm just going to tell you that don't try to do this yourself. You have to go to a professional company that takes care of conservation easements, that provides them for you. But essentially, what happens is you purchase a piece of property, and then that property gets designated as a conservation, and it acts as a donation. And what happens is that it gets valued a different way than the actual purchase price of it. So essentially, you could get 4 to 5 times the value as a write-off for making that donation. to the actual expense. So if you spend $25,000 and then you get an easement of $100,000 to $125,000, you've essentially taken it's essentially cost you $25,000 to reduce your income by $100,000 or $125,000, and that could be a way to get your income down below the threshold and save the QBI, and essentially you'll save more in taxes than it costs you to put the conservation easement into place. That's a much higher level tax strategy, but it's something that you can consider doing, and you need to do it before year end. So I hope that some of these tips were helpful for you. There's all kinds of other things that you might not know about. If you travel a lot, so if you go to conferences and things like that, you already know that you could deduct your airfare, your hotel, but I don't know if you're aware that for meals while you're traveling, you can either deduct your actual expenses of what you paid for the meals while you're traveling, or you can use a per diem rate. And the per diem rate is set by the federal government, and it's geographically specified. So it depends on what city you're traveling to as to what that daily rate is. But often, when we're traveling, especially if you're going to a conference, maybe the conference is feeding you, or maybe you're meeting other people and someone else is picking up the tab, you might not end up spending nearly as much as the per diem rate allows. So you can essentially claim that per diem rate for each of your days of travel, even if you didn't have that expense out of pocket. So that could be another way to increase your expenses significantly, especially if you're doing a lot of travel. So I think I'm going to wrap it up here. There are definitely more tricks and tips for you to save in general on your tax bill, your tax liability. But these are some of the things that you might want to consider looking at as we're nearing the end of the year. I hope this information was helpful for you. Once again, we have this amazing summit coming up, 30 speakers, 5 tracks, all about growing your law firm, making it more profitable, getting your life back. And I'm really, really excited for it. I'm excited to hopefully see you there. It's completely virtual, and it is free to attend. So there's no reason not to sign up for it. So go to lawfirmgrowthsummit.com, lawfirmgrowthsummit.com, and sign up today. And with that, I am going to bid you farewell until our next episode. I will see you soon. Have you been enjoying the show? We sure hope so. To make sure you never miss an episode, be sure to hit the subscribe button in your podcast player app. Next week, we will be back with more valuable resources and ideas on how to break the mold and take your law firm to the next level.